G'day crew, my name's Oscar Pelazon and welcome to another episode of Tube Time Tuesdays. Well, I'm back in front of Surfing WA building today. Not a lot going on out there. There are a few groups of school kids doing their PE lessons down the beach, and I couldn't think of a better way of spending your day than in the ocean. But rather than having a surf, because there's not a lot going on, I thought I'd delve back into my accounting days. Which is making me feel a little bit uncomfortable and getting my twitch back, right? After 22 years as a chartered accountant, I heard the same question around tax planning time every year. And people would go, I'd be talking to them about, what their profit is and how we could manage their tax. And you'd share with them what their profit estimates were going to be. And they go, how could I have made such a large profit when I never have any cash in the bank? Now let's break it down. There's 5 key reasons why your cash is going to be or can be different from your profit. So the first reason you're going to have differences between your cash balance and your profit earned for a period is timing differences. Pretty simple. Your profit and loss is for a period of time. It's either for a month or a quarter or a year. Your bank balance, that's at a particular date in time or a particular point in time. It's a snapshot. Bang, right there, right then. The other thing is you may have recorded revenue or expenses in your profit and loss statement, but the cash hasn't been received for it yet, and it hasn't been paid out yet. Purchasing goods from suppliers on credit or selling goods to customers on credit. Secondly, 2, capital expenditure or purchasing assets. When you purchase an asset like a computer or machinery, vehicles, office equipment, office furniture, the cost of that is spread out over the life of the asset in the form of depreciation in your profit and loss statement. However, the actual cash payment for that asset, if you paid cash, happens up front, and that reduces your bank balance immediately. Thirdly, non-cash expenses, primarily depreciation and amortization. As I said before, these are expenses that reduce your profit but don't involve any cash outflow. You might have significant depreciation of assets that you're on your balance sheet that have been bought in prior periods, but you're expensing their effective usage in the period that you're looking at and calculating your profit for. But as I said, the cash outflow happened in a previous period. Fourthly, profit distributions. Taking advances on your profit over and above your salary that you pay yourself, such as dividends or trust distributions, are not an expense to the business, but they do reduce your cash balance. And finally, loan principal repayments. While the interest on the loans that you have to fund your business are recorded as an expense and affect the profit, reduce the profit, the repayment of the principal doesn't affect profit, but it does reduce your cash. Plenty of profitable businesses go broke because they don't manage their cash flow effectively. Understanding the key drivers of both profitability and your cash flow will help you make better business decisions in your business, improve your profit, improve your cash flow, and reduce the stress of running your business. That's it for me today. I look forward to seeing you next week for another episode of Tube Time Tuesday. Happy days. Yeww.